They spend 9 months of the year encouraging and replenishing wildlife after 3 months of hunting.
Oh.
He's also an excellent golfer. He jogs, plays racquetball, and was given a basketball scholarship to Texas A&M, though he later transferred to Oklahoma State and concentrated on his geology degree, preparing himself for the business world, where he's earned reputations such as ruthless and a bandit.
No, I don't think ruthless. You know, I mean, you look back over the record, it's been pretty, I think somebody being ruthless, it would not be fair. I think, you know, that successful people generally like themselves. And there's nothing that we're doing that could be identified as being a bandit. We've helped the Gulf stockholders, and we've helped the Mesa stockholders. We've maybe kind of hurt the egos of a few managers, but, I mean, who's going to worry about that? Oh.
Good afternoon. I'm William Teitelbaum. On behalf of University Television Network, I want to welcome you to this live satellite broadcast, Bulls, Bears, and Boone Pickens, Corporate Restructuring and Corporate Growth. UTN will be enjoying its largest program following to date, from universities and colleges nationwide, including campuses in California to New York, from Washington to Louisiana, and we extend a warm welcome to all participants nationwide in this stellar learning event. We'd also like to extend a warm welcome to our host campus here in Los Angeles, Pepperdine University, School of Business and Management, and the outstanding Southern California executives who are participating in the studio. As you know, this is not a press conference, it's not a media event, but rather an academic investigation into the many faceted merger-acquisition phenomenon taking place in the United States today. To aid us in our discovery process, we've invited an outstanding panel of experts from the academic and business communities. Panel members include Dr. David Hitchen, Professor of Management at Pepperdine University, who will be coordinating our questions from our studio. Mr. Richard Torrey, President of Tor West Capital, Newport Beach, an investment banker. Mr. J. Terrence Greevy, publisher of the Journal of Buyouts and Acquisitions, San Diego, California, and Mr. Ron Betton, Senior Vice President, Bear Stearns, Los Angeles, California. Ladies and gentlemen, our panel. Few people have the impact on big business as T. Boone Pickens. You've read about his activities in the news, you've heard of his controversial tactics on Wall Street, and today, October 25th, we'll take a closer look at the man and the issues. Ladies and gentlemen of the academic and business communities, let's have a warm welcome for the man from Amarillo, Texas, Mr. T. Boone Pickens, Chairman of Mesa Petroleum.
Bill, thank you very much. We're going to have a fun day today. It's going to be a pleasure to participate in the teleconference, and I look forward to addressing the issues of mergers and acquisitions and also to receive your responses. As you know, Mesa is no stranger to mergers. Most of you are aware of the investments in the last few years since 1982. There have been 5 deals that we've been prominently involved with. That would be City Service, General American Oil, Gulf, Phillips, and Unocal. But you may not be aware of the takeovers that occurred long before for Mesa Petroleum. And let me take you back to 1969 when we acquired a company that was 20 times our size, which was Houghton Production Company. And in 1973, we acquired Pubco Petroleum Corporation, which was 1/5 our size. And in 1984, we acquired the Mesa Royalty Trust. Now, I know that some of you may say that the Mesa Royalty Trust was an inside type transaction. It was inside to the point that that we dealt only with the shareholders. We did not have to deal with the management. Consequently, it got very little press. There was not any, it was not a complicated deal, but it was a very large deal. It was one of the 10 largest oil and gas deals in 1984. But the tender offer went straight to the shareholders, and 89% of those shareholders voted in favor of it. The point is that Mesa has always considered acquisitions a viable means of corporate growth. And we believe, as I believe as the CEO of the second largest independent oil company in the United States, that my role is to do the best I can with the capital I have available to me to do the best job to maximize values for my shareholders. And consequently, we have used the takeover acquisition process for many years. It's been good for our shareholders from the time we came public in 1964. Had you had a $10,000 investment in Mesa at that time, today would be worth about $300,000. Now, what's it done for the shareholders of other companies we've been involved in? The 5 companies that I mentioned, Gulf, City Service, General American, Phillips, and Unocal, there were 750,000 stockholders in those companies. Their pre-tax profit was $13 billion. Pre-tax, I say, because actually the federal government on taxes was able to pick up something over $3 billion in taxes. Now, I'm not out working for the federal government to generate tax revenues. I just make that as a point, though, and I think a very interesting one. But we've attempted to work within the free enterprise system to buy undervalued assets and then create more value from them by upgrading the values in the marketplace. But our efforts have been sincere, they have been above board, and we've always played by the rules. Now, the Good Old Boys Club paints our efforts as a grand scheme to, quote, bust up American industry, to liquidate, to dismember, and destroy companies. That's ludicrous. Let me leave you with one point. Would anybody go out and invest $1 billion in another company with the thought of destroying it? Of course not. We put the $1 billion into the company because we thought we could make it more valuable than the prior management had done for the stockholders. Now, if you look back over our record, we have a good record of not destroying, but building. You look at Mesa Petroleum that started with $2,500 paid in capital in 1956, went public in 1964 with a balance sheet that reflected less than $2 million in assets. Today, the balance sheet reflects $4 billion in assets. So the record is excellent from the standpoint of growth. Unfortunately, the good old boys have made great headway in perpetrating this hoax on the investing public that we're going to destroy something. And remember that when you're talking about the large corporations that have been against me, they have very large PR departments who stay very busy telling the rest of the world what a bad guy Boone Pickens is. But they've succeeded in stirring up Congress to consider legislation against stockholders and to further, and I underline, entrench managements. They've devised elaborate ways to protect the kingdom, and you can't believe how much money they've actually spent of the stockholders' money to entrench themselves even further. And I usually see things fairly clearly. I had a banker tell me one time, said, there's not much gray in your life. And I said, no, thank God there isn't. But I do see things clearly, and shareholders, I believe, own companies. I don't think managements own companies. I know as a manager of Mesa Petroleum, I'm an employee. I don't own Mesa Petroleum. If I wanted to own it, we should have never gone public. Once you're a public-owned company, the stock is available to anybody that wants to buy it, and you work for the stockholders. I think also that if the stockholders own a company, they should be allowed to look at any offer that's made for those assets. I think it's their call. It's no different than you owning a house you paid $50,000 for. Somebody offers you $100,000. Of course, you're the one to make the decision as to whether you want to sell the house or not. You don't have to go to somebody down the street or to some governmental agency to ask them, could you sell the house? Of course not. It's the same way, as far as I'm concerned, as a stockholder. A stockholder is the owner. The stockholder should be allowed to decide whether they want to sell the stock or not. Hostile, when you see hostile in these deals, hostile is only in the mind of the chairman of the takeover company. It certainly isn't in the mind of the stockholders. Example, I testified before the Senate Banking Committee several months ago, and upon leaving that hearing, that I had a person take hold of my arm and said, Mr. Pickens, said, I want you to know that the chairman of Unocal, he feels the offer is hostile. He said, I'm a stockholder of Unocal, and he said, I consider it to be downright friendly. And that's what it boils down to. Management's afraid of losing their jobs. They view tender offers as a personal threat, and it really does bruise their egos when these things happen. I think, however, takeovers are becoming more understood all the time by the investing public, by the general public, and by the Congress of the United States. Shareholders, especially institutions, are becoming more and more aware of managements and what managements are trying to do. And it will become better understood as we keep one thing in mind. Mergers and acquisitions are a basic function of the free market. If managements don't do their jobs, then obviously the stocks of the companies they work for will be low priced in the marketplace. Consequently, they become vulnerable. The price is down, the company is vulnerable to an offer. It's that simple. If we allow managements to convince us otherwise, we'll not only lose our competitive edge in this country, but we'll also lose the confidence of the investing public. And that's where the issue becomes very serious. Shareholders supply the capital that fuels the economic system. They are the cornerstone of the system. And remember, there are 42 million stockholders in America today. That's 1 out of every 6 people own stock in a public-owned company in this country. I think that is absolutely so great that you have 42 million people, and I'll be glad when it's 84 million people or 150 million people that own stock in public-owned companies in this country. And they're held together by the best glue that you can ever imagine. It's their money. And I can tell you that's when it gets serious, is when you have your money up, you want to be treated fairly. And we must keep their interest paramount. And that concludes my remarks, and I look forward to hearing your responses and questions. Thank you.
We're going to be back after a short break. Stay with us.
University Television Network is pleased to announce an outstanding lineup of continuing education satellite offerings beginning winter semester 1986. On March 7th, UTN presents super entrepreneur Mark McCormick and What They Don't Teach You at Harvard Business School, a must for the business management professional. In April, a unique science offering will feature renowned astrophysicist Dr. William Kaufman in black holes, quasars, and exploding galaxies in celebration of Halley's Comet. UTN announces SAT by SAT, a high-powered SAT training and career awareness seminar for college-bound youth, available now for your continuing education catalogs. Future offerings also include advertising copywriting techniques. Learn to produce written messages that get results under the guidance of Mr. Guy Day, president of the world's foremost ad agency, Chiat Day. Also, computer graphics, art technology of the future, featuring the leaders of an art form which is revolutionizing the communications design industry. For programming information on these and other UTN offerings, please contact University Television Network at 1330 North Vine Street, Hollywood, California, 90028.
Hello and welcome back to Bulls, Bears, and T. Boone Pickens. We do have a live studio question, and if you'd state your name and your question.
Yes, my name is Lieb Orlansky. My question for Mr. Pickens is, do you feel that as a result of the Unocal decision that the balance of power has shifted in favor of managements seeking to entrench themselves?
Lieb, my feeling about the Delaware decision where they discriminated against a stockholder, I think that's going to be a blip in the mergers, acquisitions, takeover arena. And let me explain that. I believe that the SEC will, under the Williams Act, will exercise their authority whereby all stockholders will be treated the same. that there would be no discrimination against any stockholder. I think that the Delaware decision is unique in that it actually killed a deal that could have been made. Unfortunately, we were the ones that were in the deal. But I don't think that decision is going to be, I don't think it's going to be upheld. It's going to, I know it's the Supreme Court of Delaware, but nonetheless, given the circumstances, again, I believe the Delaware court would rule that all stockholders should be treated equally.
Thank you, sir.
Thank you. Mr. Ron Benton.
Boone, you've addressed the area of shareholders' rights and that more and more shareholders are becoming aware of what's happening with managements. Who's going to lead this shareholder rebellion, if we want to call it that?
Ron, the leader should be the institutional holders because they have a fiduciary responsibility, they have research capability, they have the recommendation coming to them continually as to how they should vote in a critical issue. It should be an easy call because they are fiduciaries. They have tremendous pressure put on them, and I'm disappointed at times when institutional holders will not respond. They don't always have to vote with me, but they should follow the advice of their proxy committees. I don't think that's in place yet, and I think that they may need a nudge or two from the Labor Department, ERISA people, to be sure that they are acting in a fiduciary role. That will work out. Also, your smaller stockholder is catching on rather fast now as to what's happening and understanding clearly that managements do not own companies and stockholders do own companies. So I think it's, we've progressed a lot in the last 2 or 3 years, and I think you'll see it snowball.
Terry, I think you wanted to just make a note on.
Yes, Boone, before you made a comment that you would be happy if the number of individual shareholders doubled or tripled. Do I understand you correctly that you would favor less institutional concentration of shareholdings?
No, the institutional holdings do not concern me because institutions are really made up of people just like us here and the people that are watching this show today. I mean, they're made up of teachers and firemen and policemen and businessmen and whatever else. I mean, make up these institutional holdings, large holdings of pension dollars. So I see that's healthy. But also, for more people in this country to become stockholders either through institutional ownership or direct ownership, I think is also healthy because I believe that we're on a wave of entrepreneurial rebirth in this country. And I can see it. I can see it on college campuses. I can see it out with business people that I work with. So I like to see people have their money up, and consequently they'll take a much greater interest in what's going on.
Dick Torrey.
Boone, you mentioned something very interesting in response to Ron's question relative to ERISA perhaps becoming more visible in having the institutional investors more accountable for their actions. How might you envision that happening?
Oh, I think that you're going to find that the institutional people are going to, I identify some of them now, when we see how they vote in different transactions. We call them fiduciaries and non-fiduciaries. The non-fiduciaries completely ignoring the question, but being sure that they appease managements in certain companies. I think that's going to come to a halt, and that's good. We see it in bank trust departments. I mean, somebody tried to tell me that there's a Chinese wall between the trust department and the lending side. They don't know what they're talking about. They're meeting someplace and discussing things. I mean, it's either at the bank or in the men's room or someplace else where these decisions are made. But you can see the bank trust departments many times are not voting in the best interest of the beneficial owners.
How might you see the government intervention relative to that question?
Well, I think those are clear violations under ERISA. And consequently, I think that you're going to see them become more and more interested in how some of these fiduciaries are voting.
We'll take another studio question from Dr. David Hitchin. Mr. Hitchin?
Mr. Pickens, we certainly share your concern for inappropriate and inefficient management, and in particular in handling of particular assets. However, there's been a concern that the so-called shark repellents that are frequently adopted to entrench the existing management are in fact having the effect of just that, entrenching the management and thus saddling the stockholders with inefficient management. How would you respond to that?
Well, it's interesting. I think this is a question that should be focused on here for a minute. That if you look at the study that Dr. Greg Jarrell, who's the chief economist for the SEC, has done on this very question, there's no doubt that this will start to affect the price of the stock, because it naturally entrenchment devices are going to make you know, the likelihood of somebody being interested in acquiring the assets be less and less. Now we have the shark repellents at Mesa, and I've said many times that the reason why we have them is if we are after some other company, that we need that to protect us until we can finish the project that we've started. We have also said very clearly that if you want to make an offer today for Mesa Petroleum, all shark repellents go off, golden parachutes go off. We won't take those. I've said that I'll stay through an orderly transition if you take over the company, and that you don't have to pay me past 5 o'clock on the day you release me, and I won't even take the desk set off the desk when I leave. You can have that too, because the company belongs to the stockholders, clearly. We have also said that on our shark repellents, they should be voted on every year, and that will be the case in April 1986 when our proxy material comes out, that they will be voted on. So I think shark repellents, you know, if the stockholders want it, so be it. It's their company. But I think that the fluid nature of stockholders changing every year or every 6 months or every 3 months, that they should have an opportunity to vote again each year as to whether they want shark repellents or not.
Thank you. Before we take another studio question, let's take a question from the panel. Mr. Ron Benton.
Boone, Mesa Petroleum is changing from a publicly held corporation to a master limited partnership. What inspired, so what was the motivation to make this change?
Ron, we had 4 options available to us as to where we could go. And again, that may be the simplistic approach. But one was to be an aggressive explorer. We have very poor gas markets today for natural gas. We have an uncertain oil price, and with those uncertainties, it made the economics of being an aggressive explorer quite unwise. And I think that you see that all across the industry. I can demonstrate 2 statistics to prove that fact. In 1981 December, there were 4,531 rigs running in this country. Today we have 1,839 rigs. The reason we don't have any more than that, there's plenty of money in the industry. If you look at Larry Rawls with Exxon's remarks before the Mid-Continent Oil and Gas Association 4 weeks ago, he said that Exxon has plenty of cash flow but has limited investment opportunity. Consequently, they're buying their own stock, which I think is very smart on Exxon's part. We looked we couldn't be an aggressive explorer because the economics just weren't there for us. Second, we could continue to attempt to acquire. We've tried that, and we have been unsuccessful at making an acquisition. We were putting up 100% of the money, taking 100% of the heat, doing 100% of the work, and we were getting about 10 or 15% of the profit. So that didn't seem to be the most logical approach, because we weren't being successful in acquiring any company. And we were sincere about wanting to make those acquisitions. The third option that was available to us was to diversify. And I tried that back in 1974, had been unsuccessful on that, and I didn't feel comfortable with diversification. Again, I'm charged with the responsibility of doing the best I can with the capital I have available. The fourth was to restructure. So we said, let's put it in the best form to do the best and maximize values for the stockholders. Consequently, we'll flow through to the stockholders starting in 1986 about $150 million a year. Now then, if the opportunity for exploration comes back to us, say in the late 80s or early 90s, we have a structure where we can go back to being an aggressive explorer. I wanted, over that period of time, not to sit there and to keep my job and to somehow put that money back to use in the ground when we weren't getting good results. I didn't want that responsibility. So we'll flow it through the master limited partnership to the unit holders or the shareholders of the company, and at the time that exploration seems to be the way to go, we have a structure where we can go back into that.
The 20/20 hindsight so valuable. We can look back at the unsuccessful diversification. What would have been successful now, looking back? Again, what
was our diversification?
Yes.
We were in the cattle business. We went in the cattle business in 1969, And I think that in 1973, we probably were the largest in the business as far as ownership of cattle. We owned 185,000 head. Now, that's a lot of animals. I'm not kidding you. And in 1974, if you look at what happened to the cattle business, we were right in the middle of it. And we did take a substantial loss in 74 and realized that, you know, there's no doubt. We didn't realize that cattle were a commodity. Of course, we know that. Oil and gas is a commodity also. But we decided that best cattle business was owned privately and not in a corporate form.
Great. Let's take another question, if we might, from our studio audience. Yes?
The next question comes from Dean James Wilburn from the School of Business and Management at Pepperdine University.
Thank you.
Thank you, Dr. Hitchin. I'd like, first of all, as an old Amarillo boy, to welcome you to Pepperdine.
Thank you, Jim.
Boone Pickens. We're especially delighted you recently visited Harvard, which is kind of the Pepperdine of the East. I certainly agree with you that corporations are owned by their shareholders. I think there's a larger sense, however, in which they may be seen as a national resource. We train a lot of people at Pepperdine from Hughes Aircraft, for instance, which until recently was not a publicly held corporation, and probably if its balance sheet had been looked at publicly every year, there would have been some tremendous cash reserves there by the nature of the corporation. The result is that they've had the cash to become almost a national laboratory. They've developed a laser beam and a number of other things that had they not had those cash reserves, they would not have been able to do with medical breakthroughs that have benefited the entire nation. And I guess what I'd like to ask is, viewing a publicly held corporation not only as a possession, as something that belongs to the shareholders, but also as a national resource, are there some specific ways in which the recent move by Mesa Petroleum against Unocal left the nation as a whole better able to compete in a world that is increasingly competitive, if not hostile? Would you address that? Viewing them
now,
as
Jim, the way I'm understanding the question is that the move on Unocal, would it have left the nation less able to compete? Is that?
Yeah. After it's over with the tremendous debt that Unocal has, are there some ways in which now the nation is better off than it was before? Is it worse off than it was before in terms of its ability to pursue research and development, to stay on the cutting edge, whether it may not be, this may not be the time to explore, but certainly there are other things that those cash reserves could be doing to be productive, to keep that national resource as a company on the cutting edge?
Well, I mean, we know where the cash went in Unocal. It went to the stockholders of the company, which were the owners. That's where the cash was going. Now, I think if you look at Dr. Greg Gerald's another study by Greg Gerald at the SEC, he clearly shows that the companies that have been vulnerable are also the companies that have really their R&D has not been up to par with sometimes their competition. I don't see that R&D is a problem in the case of Unocal. I believe that their R&D was something like $50 million a year, and their budget was something over $1 billion. So there's plenty of room at Unocal to continue to run their R&D. As far as their debt's concerned, that debt, we didn't put that debt on the company. I realize where the money went, and I think that's healthy because it went to the stockholders. But that debt was put on by the management of the company and not by us. Now, we had, if you recall, we offered $54 a share for Unocal. Today, the blended price of Unocal is in the low 40s. So there is, and I believe that the management of Unocal said that the value of the company was $72 a share. Today, it's selling for $29 a share in the marketplace. So there's a big gap between 29 and 72 that the management of Unocal needs to get the price up. We're still Unocal's largest stockholder, and we are very interested in what the company, how it performs.
Thank you.
Thank you very much.
Can I interject something?
Absolutely, Ron.
Boone just mentioned that he's the single largest shareholder of Unocal, and I'd like to welcome and thank Boone for appearing on this program. And it's refreshing to see that he is out and is addressing the nation in contrast to other CEOs of companies The chairman of the board of Unical won't even talk to his major shareholder.
Why is that, though? Why do they take such a mute role?
Well, someone who represents my clients own Unical, and I represent Wall Street on this panel, and I think it's an outrage myself that when management won't talk to their shareholders. And I can tell you, some of the people out in the audience may be some of my clients who are attending this, and I've called up managements at times and say that I represent their shareholders, and sometimes they talk to me and sometimes they don't. Mr. Pickens will always talk to his shareholders.
That's who I work for.
Boone, you addressed the area of the Old Boys Club, the round table, management, trench management, whatever words you want to use. What's going to happen in the future, my generation?
Ron, you know, I think we're coming to an end of a period which is terribly important for this country, and especially corporate America. I think you're going to see the good old boys phased out. They would phase out by age alone, for one thing, but it's happening much faster because the economics that are driving the mergers and acquisition takeover game right now. But you're coming into a new period for this country. You're going to see the 40, 45-year-olds moving up now, and I think they have different values than the ones that are going out. Now, I recognize the good old boys came in after World War II. Cecil Mackey at Michigan State, Dr. Mackey, pointed out to me that I was wrong on the time. He said it actually was before World War II when this all started. But you saw the professional manager come in, and it was a game of perks. You know, what else can we give ourselves that we haven't thought of? Well, if you have a great scad of these people out there running these companies, well, they look over and see one receiving a perk that they don't have, and so it becomes a domino game, and they all get one just like it. And I think that's what I see, is that you're having the people, the young people that came along in the 60s in college today are moving into those key spots. And I think their values are entirely different. I think those kind of that kind of attitude to sit and actually just use stockholders' money as if it was your own, run the company as if it was a private corporation, I think that turns these people off. And what I see on college campuses today is no different than what we saw in 1965 as far as attitude was concerned. It was frustration on the part of the college student. In the 60s, they demonstrated, and today they know they can work within the system and make the changes. It's interesting to see, because they hate the bureaucracy just like I do. And so you've got a new breed coming up, and I think it's going to be terribly exciting for this country. I think you're going to see a whole different attitude in corporate America. I think you're going to see an accountability that we haven't had.
Fine. Mr. Dick Torrey.
Boone, relative to the issue of the favorable economics of the merger and acquisition movement at present, you have frequently referred to the issue of the arbitrage, or the discount, between the recognizable selling price of the stock vis-a-vis the appraised valuation, and how the market might perceive it. Could you define for us in your own terms what you mean by appraised value? Secondly, doesn't the market give a liquidity discount to those appraised values, and therefore there is a suppression or a differential in price? And lastly, if in fact appraised value is a definable number, isn't there an assumption that there is an orderly marketplace to support those numbers? And if in fact all oil companies chose to dispose of their reserves simultaneously, wouldn't that destroy the appraised value?
No, I don't think so. Let me start at the end and come back the other way. Okay, the appraised value is you know, is based on transactions that have been made in the past. I mean, if we believe oil in the ground's worth $9 a barrel, for instance, that's one. And of course, that's a rule of thumb, because the life of the reserves changes values because of discounting the future net revenue. But if, you know, to me, Dick, that what you go back to, what is somebody willing to pay for these assets? And so if there is a huge discount to what is perceived to be the appraised value, is somebody willing to step in there and say, I'll pay $35 for that because I'm coming up with an appraised value of $75? That, again, to me, is a free enterprise system working at its best. Somebody believes that those assets are worth more than what they're selling in the marketplace for.
Right, but if everyone begins selling simultaneously, then you have a shrinkage in those values.
Well, when you say selling, that we're talking about buying now.
Well, you're on the buy side of the equation. Perhaps some of the targets that you've referred to previously have been on the sell side.
Well, but still, though, if we're gonna evaluate, for instance, let's say Gulf Oil. Gulf was selling at about $37 a share when we bought the first share of stock. We believe that the appraised value of that company was close to $95. The company was in liquidation because they hadn't replaced the reserves for 12 straight years. I didn't believe that the company stock could ever go above 40 again unless you had a fly-up in price for oil and natural gas. It's the only way it could go above 40. I did not see when that fly-up would come, maybe out in the 90s, but by that time they had depleted so much off the reserve base, the fly-up would never be felt. So the stock could not go above 40 again. We were willing to go in, and the all-time high for Gulf was 57. And if you recall, we made a partial tender offer for $65 finally when we got backed into the corner. And then along came Arco and Chevron's offer. Arco offering, I think, 70, and Chevron offered 80, and then there was a Kohlberg-Kravis leveraged buyout offer for $87.50. Well, somebody believed those assets were greater than that. Now, if another one did that at the same time, still, I believe that there would not have been another Chevron buying Gulf. I think that those mega mergers are over with. I don't think those are in the best interest of the stockholders of the acquirer. It's pretty nice for the acquiree's stockholders. But if you're going to favor somebody's stockholders, who do you favor? You favor your own stockholders. And that's what Exxon is doing for their stockholders today. Exxon's not trying to acquire. They're trying to get the price of their stock up in the marketplace. And really, that's what we're paid to do. And if you look at, I mean, why does anybody ever buy a share of stock? Because they believe the price of the stock's going to go up. And then it becomes the responsibility of the management of the company to be sure that they deliver. So if they continue to sell substantially below the appraised value, or what somebody perceives to be the appraised value, then they're going to be vulnerable.
If you are temporarily out of the acquisition game, and Mesa no longer will enjoy the revenues from the activities of the past several years, how do you plan to keep the stock price of Mesa up at its current level?
Well, Mesa will be a master limited partnership if the stockholders vote for that on December the 4th. And then we will start to flow through the cash to the stockholders at the end of the first quarter of 1986. Mesa Petroleum will cease to exist in the first half of 1987 when we finally have disposed of the Unocal stock in the corporation that we hold. So there'll be two pieces of paper that Mesa Petroleum and the Mesa Master Limited Partnership trading. After the first of 87 and sometime before the middle of 87, there will no longer be Mesa Petroleum, only the Master Limited Partnership. How do we expect to deliver for the stockholders there? That we know that what we're dealing with at that point, and we've already agreed in 1985 we couldn't replace our reserves. And upon not being able to replace the reserves, we believe you have to put it in the best structure to get maximum value for the stockholders. So it will trade on a yield multiple. Now, we'll have to see after December the 4th, if the stockholders vote for the Master Limited Partnership, what we can contribute in the future. And there are other things that we can do. I mean, we'll have over 400 million shares of Master Limited Partnership units, which will be able to trade as if we had currency for other deals. They'll have to almost be friendly deals. I don't want to close any doors here, but I would say that 90% sure that they will be friendly deals. And we believe that we will have something to trade with. So, you know, our record is quite good, and I think the best way to look at management is look at the history of management's achievements. And we have always been able to deliver, but for the stockholders. But in this case, as it has been in Mesa Petroleum, it will be in the limited partnership. 90% of my net worth will be in the limited partnership, as it was in Mesa Petroleum. So you can bet your life that I am going to be in there working hard for myself and the other limited partners.
I'd like to ask a question, though, moving into the present, leaving the past. Boone, your activities have been accredited with accelerating takeover movement. How long do you visualize the phenomenon going on?
It will go on very clearly to me, Bill. It'll go on as long as assets are undervalued in a public marketplace. That's it. As long as they're undervalued and there's money to be, and the money's available to take advantage of this situation. As long as that money is there and the assets are perceived to be undervalued, the movement will continue.
Is this the creative financing that we're finding?
There's no doubt about it. That is a part of the activity.
Fine. Mr. Greavy?
Yes, Boone, you have been relatively unsuccessful in affecting some of the takeovers of the large companies because a white knight usually comes into the picture and overbids the price. But if you had been successful, say in the case of the Phillips deal, what, aside from moving to Bartlesville, Oklahoma, would you have done as a manager of the Phillips Petroleum Corporation? What specific actions would you have taken?
Well, Terry, if you let's approach it this way. Again, back to history. We've had a good record of starting from a standing start and making a very viable company, an exciting company out of Mesa Petroleum. One thing that I used to work for Phillips, and it's bureaucratic in design. I don't think even the Phillips people would argue that point with you, as most very large oil companies have become. I think that we would cut out layers of reporting. I can't specifically tell you that I would expand this division and minimize this division, but to put it in the words of Sir James Goldsmith, who is a very eloquent speaker, and we were before the Senate Banking Committee, if you can imagine, the three panelists were Fred Hartley, myself, and Sir James Goldsmith. We had Fred in the middle, so Fred, his opening remarks were supposed to be 5 minutes, and I think he went 38 minutes. And I have, after testifying before 17 committees, House and Senate committees in the last 24 months, I know they don't pay much attention to your opening remarks because they're filed for the record with the committee, and they're lining up the questions they're going to ask you, so you might as well limit your time, and I did. I went about 3 minutes. Fred was substantially longer than that, and said that if Pickens had taken over Unocal, 22,000 people would have lost their jobs. And when we got down to Sir James Goldsmith, well, Jimmy said that I don't like to see somebody demagogue, and he said that that's what I feel Mr. Hartley was doing. I want to say this, that in the event that Mr. Pickens took over Unocal, one person would have lost their job, and 22,000 people would have gone on doing just what they were doing. I think this is analogous to Phillips, too, that there would have been some people at the top that would have lost their job. I can assure you the golden parachutes they had at Phillips would have amply taken care of that management. And Goldsmith went further to say if Mr. Pickens had not been successful in running Unocal, one other person would have lost their job, Mr. Pickens. And then their 22,000 people would have gone on running Unocal just like they had in the past. There's no way that these companies are going to, you're not going to, destruct. Marty Lipton with the Wachtell-Lipton firm made the statement that you turn the companies into a dust bowl. Well, let me tell you, I know more about dust bowls probably than anybody in the room. I was born in Oklahoma in 1928, and that's good for knowing about dust bowls, I can assure you. But you're not going to turn anything into a dust bowl. You're going to go in and because of your financial commitment to it, you're going to make it a more dynamic company than it's ever been before, because you're going to work harder to achieve those conclusions.
Let's take a studio question, if we might.
Our next question is from Dr. Wayne Gertmanian, Professor of Economics, School of Business, Pepperdine University.
Thank you.
Mr. Pickens, first let me thank you for those kind words about university economists. I know I paid you $10, but it was really worth it.
You haven't paid me yet. I'll look you up after that.
In the current issue of Business Week, Nobel laureate Franco Modigliani stated that the business community had misused his theory of corporate finance, that leverage buyouts have caused companies to be much too much in debt, and that excessive debt is destabilizing the economy. Yet upon hearing about your attempted takeover of Union Oil, he purchased the stock and made a short-term profit.
Good for Dr. Modigliani.
Can we conclude then that what is best for an MIT economist in the short run is at odds with what is best for the economy in the long run? Is the increase in debt caused by corporate raids at odds with the health of the U.S. economy?
I don't think so, and the reason being the short-term, long-term is a defense that was developed by the by the larger companies that had to come up with some defense. You know, they'll also use national security as a defense, which is interesting to hear that theory. But the short-term, long-term, if managements have looked after their stockholders, the short-term and the long-term will both be taken care of. There isn't anybody that I know that plans for short-term, long-term. They plan to do a good job for the stockholders if they're good managers. Now, it's interesting when you know, the long-term debt, the money that's paid for this, for these companies, when you leverage them up, where does the money go? The money goes directly out to the stockholders is where it goes. I mean, it isn't, I mean, it's a perfect cycle as far as I'm concerned. That, for instance, I know that some of the senators were very concerned about Chevron borrowing $13 billion to buy Gulf oil. The $13 billion went into the pockets of 400,000 stockholders, which immediately went into the economy. It went in to buy more stocks, automobiles, houses, some went into savings or whatever else. But the money is not dropping into a black hole someplace, as you well know as an economist. It's right back into the system again. So I have no problem with this. I also find that the managements that are so quick to talk about Pickens is interested only in the short term. He's an asset stripper. Well, where did I ever strip any assets? No place. There isn't any place they can put their finger on me that I've destroyed, assets stripped, liquidated. None of those things. There isn't anybody that can show me where that happened. But at the same time, these same executives, how are they compensated? They're compensated for the short term. If you look at the Conference Board study that has just come out, it isn't 30 days old, they clearly state in there that compensations for executives are done on a short-term basis. But yet they talk about Pickens isn't interested in the long term. I'm interested in short, long-term, and intermediate. I'm interested in doing a job for stockholders. That's what we're paid to do.
So why are there so many mixed reviews lately?
Mixed reviews coming from where?
Well, we've on that particular tape that we were going to watch, we had noticed that Mr. Pickens has had a positive effect on the economy in general. This was from Dr. Art Laffer, had made a statement. And if you have had such a positive effect on the economy in general, then why has Mr. Pickens received so many mixed reviews lately?
Well, the mixed reviews, I can tell you where they're basically coming from. You're coming from the largest corporations in America, and they do have PR departments, and those PR departments are constantly trying to destroy credibility wherever they can. I mean, they spend a lot of time at it because I've had friends in the media that have sent me some of the information that they have sent out on me. And they still, none of them will debate me. They've had opportunity after opportunity. They must have had it now at least 24 chances to expose me for the scoundrel they say I am. But,
including on this show.
But they won't come and jerk the cover off of Boone Pickens and show everybody what a bad guy he is.
Mr. Greavy.
Yes, Boone. I'd like to address the issue of oil reserves in the U.S. on an ongoing basis. The oil industry is going through some troubled times right now. Prices are down. The supply and demand balance has changed. But is it conceivable that we could be looking back 10, 15 years from now where it turns the other way, where we have another embargo? And we'll look back upon this time where there has not been any exploration activity. And it is not in the best interest of this country, you know, to have taken a short-term look at things.
Well, Terry, let me ask you this. Would you propose that oil companies be required to put their cash flow back into exploration regardless of what the finding costs were?
No, I wouldn't. I'm not proposing any regulation. I'm just saying that is there not another solution that takes into perspective some of the long-term impacts?
Well, do you believe that I have stopped exploration in the United States?
No, I don't believe you've stopped exploration. I'm just saying that the economic factors, are there not some larger questions rather than the short-term perspective?
Well, let's go over the fundamentals that we're looking at. We import, what, 30% of our crude supply, which represents only 15% of our overall energy requirement daily. So 85% of our daily, that we're generating 85% of our energy needs within this country. Now, where do we get our 30% of our imported crude? Number one is Mexico, 2, Canada, Venezuela, Colombia, Nigeria, the North Sea. Now, what would happen if today we had all the crude oil that we needed in this country, developed within the country, and you didn't have to have Mexican crude? Well, Mexico's economy is struggling at best. And if you took that market away from them, I can tell you exactly what would happen in Mexico, and you know what would happen. So Mexico is a friend of the United States. So then what do? We go in and prop up their economy. I'd rather pay them for their oil than have to prop up their economy. So I don't find it unhealthy to import 30% of your crude supply. I also know as a geologist that the reserves that haven't been found in this country are not going to go anyplace. They've been there for 100 million years. So if we don't drill them in 1985, we might want to drill them in 1990 or 1995. Why do we rush to develop the remaining reserves of oil and gas that we have in this country? It really doesn't make sense to me to do that. And we have more oil worldwide than we need. So the economics, because the fact that of all the wells that have been drilled in the world today, 80% of them have been drilled in the lower 48. We're a high-cost producer in the United States. So why push an industry to do something that is not economically sound to do? Now, I'm not going to be anybody that's going to shut down any drilling rigs other than the ones that are Mesa Petroleum. I'm not going to shut any rigs down over at Chevron or Texaco or someplace else. And they're not going to shut any rigs down at Mesa Petroleum. A CEO of an oil company is only going to be responsible for the number of rigs that that company operates. And I can tell you in the oil industry, I've never seen a more independent group in my life that's in the industry. And you are not going to influence them one way or the other. They'll make up their own minds as to what they want to do.
Let's take another studio question, if we might.
Our next question comes from Nancy Ong. Nancy?
Thank you.
Yes. From an international perspective, how do you think such financial centers as London and Asia would view this solely American tactic of growth management?
I don't know. I'll be in London in 2 weeks, and I could answer that question better by the 1st of December than I could right now. But my thought is that I believe that we're admired in the United States, that we can restructure industries and even the total corporate America, which I think is exactly what's going on. And I think they see it as very healthy because both of those areas invest heavily into corporate America. So I'm supposing that they like what's going on.
The real question is, how many times have you spoken overseas?
Nancy, I'll speak in London and Zurich in November. And the last time I spoke in London was about a year ago, and I spoke in London several times and also in Paris. So it's not uncommon for me to speak in those financial centers.
Thank you.
Dick?
Now, back to the corporate restructuring movement again, if you would, Boone. Raiders today have adopted a very interesting technique relative to their acquisition activities, commonly known as the two-tiered front-end loaded tender offer. The mechanism wherein substantial cash is paid up front for controlling interest in an entity, and the trailing shareholders are then offered a heck of a lot of less cash and some form of debt security. Given your view relative to always looking to protect the small shareholders and the likelihood that small shareholders are the last guys out in many of those deals, how do you feel about that practice?
Well, Dick, I have the advantage of having heard the testimony of a lot of people in Washington because I've been on so many committees. And John Shad at the SEC spoke to this point on a question from Senator Metzenbaum from Ohio, that woe these poor people that don't get in on the offer. Well, I think John Shad answered it this way, that there's ample evidence that they are getting in on the first step of the offer. I think it was over 87% were responding and tendering into the first step. Now, again, to me, I've got to go back to who is it that owns the company? It's the stockholder. Why isn't the stockholder allowed to decide whether they want to take a two-tiered offer? They don't have to do this. Second, if you go back, and I was asked this question I don't know how many times in the CBS Ted Turner situation by senator after senator or congressman after congressman, do you think this is a good deal for the CBS stockholders? I said, well, first, I'm not a CBS stockholder. I said, I can remember CBS less than a year ago was $60, and today it's selling for $115. Now, I said, something's happened to cause CBS to go from 60 to 115. I don't know whether Ted Turner caused this or not, but I said, to me, they said, well, it's only paper that Ted Turner's offering. My feeling is the stockholder can decide whether he wants to take paper or not. If they don't want to take paper, don't take paper. So I don't see the front end loaded, and let me tell you, I can go back to to all of the offers that we've made, and I can only recall one that had any difference between first step, second step. So I don't see this as a problem, and I think that there's ample evidence out of the SEC to show that these front-end loaded offers, it sounds good for the defense side. Front-end loaded, bootstrapped, what's the other term that they like to use on these offers when trying to defend themselves or stay in power? But I wince when you say raider, because you see, I identify ourselves as a large investor, not a raider. When you go in and put $1 billion into a deal, I don't think you should be identified as a raider. I think that you can upgrade us at times to say large investor who has become active. But I don't like to be identified as a raider.
Let's take another question, if we might, from a studio audience.
Our next questioner is Mark Sterling from the Sterling Company. Mark.
Thank you very much.
Mr. Pickens, my name is Mark Sterling. I've been actively engaged in arranging mergers and acquisitions for the past 26 years. And I marvel at the transactions that you and Jerry Kohlberg and others have put together. I think they're really very fascinating.
I marvel at Jerry Kohlberg, too.
Now, in the future, however, since interest rates are moderate today, so that when a company doing a takeover or a buyout borrows money, the schedule shows that the cash flow will cover it. A few years ago, we had 20 or 21% prime rate. Can you foresee any serious dangers and problems if the interest rate should accelerate as they did several years ago and the economy turning down at the same time? Do you see a big problem, perhaps, in servicing the debt that many of these companies have incurred in doing leverage buyouts?
Well, Mark, the way I look at that is that if we did perceive that there was going to be a problem, then what would we do? Are you thinking about legislation?
No, not at all. Just the economics of servicing the debt.
Well, let me tell you, I wish somebody had told me back in the late 70s, quit buying offshore leases in the outer continental shelf of the Gulf of Mexico and don't drill any more wells out there, because the price of gas is not going to be $8 a thousand, it's going to be $2, and you're going to have a hard time selling it. I wish somebody had gotten a hold of me and said, this is what you're going to be faced with. But if they'd have done it, I'm not sure that I would have listened. So if we do see interest rates go back to 20, which I don't think we'll see, and I don't believe that we're going to see any serious turn down in the economy, but nonetheless, if we did, you and I can't do anything about that. I got, in the Chevron Gulf deal, I was up on the Hill in Washington, and I was trying to explain the situation that there are 400,000 stockholders here that are going to lose $6.5 billion if you don't let this deal go through at $80 a share. And I think we must have gotten through to the Senate, which I was pleased. The vote was 59 to 37, that we didn't have a merger moratorium. But I had one senator say to me the same thing you said. What if oil prices go down and interest rates go up? Couldn't Chevron have made a mistake? Well, my answer to that is they could have made a mistake. Any transaction could have been, miscalculated. Any transaction might fail. But you can't have the Congress of the United States, are taking a deal up there and say, what do you think of this? Would you all tell me whether we should make the deal or not? I mean, that is out of the question, because people at Chevron are quite capable of deciding how they're going to cover $13.2 billion acquisition. And I wouldn't be the least bit presumptuous to talk to George Keller and tell him, George, have you thought interest rates might go up? Have you thought of that point, George? Well, George, throw me out. I mean, he wouldn't have, and that's what's so great about the free enterprise system. It isn't perfect. I understand that. And some deals are not going to work like they were designed. I wished all of mine had worked like they were designed. I wish the cattle business had worked like I designed it. It didn't, and we took a $10 million loss in 1974 that I wish we hadn't have taken. But nonetheless, I don't think that we need to worry about those points. I think that's up to the people that are making the offers.